I'm joined now by Samson Esemuede, Managing Director and Chief Investment Officer of Zrosk Investment Management, to help us review some of our top stories in more detail. Good morning, Samson. Great to have you back.
Good morning, Rolake. I'm glad to be here.
So we want to start with some global inflation stories. U.S. inflation, which seems to have positively affected some of the major markets around the world, and of course China inflation numbers which missed expectations. Let's start with the U.S.
Remember the last time we were here, we actually discussed inflation.
Right.
And at the time, what I did say was that service inflation was quite sticky. And in order to see inflation trend lower, you needed to see some negative news around the labor markets, which is what has held up services inflation. And since then, what we have seen is an increase in the unemployment numbers in the US.
Okay.
Non-farm payroll has also weakened relative to expectation. And inflation has basically gone from 3.5% at the time when we spoke to 3%. So what you're seeing is a cooling of the economy and also a repricing of rate cuts in the market.
Yeah, so that means essentially the Fed's policy moves on rates have been impacting the market as it intended, right?
Pretty much. So if you look at the forward markets, which is where you get market guidance on what future rate expectations are, there is almost 100% probability of a rate cut in September.
Okay.
There is a high probability of another rate cut in December, and then there is a 50% probability of a rate cut between September and December.
Okay.
So the market has gone from, at the time when we're speaking, pricing no rate cuts at all because of how sticky inflation was, to now expecting 2 rate cuts this year and possibly 3.
Okay.
So that has impacted how equity markets have performed, how the bond markets have performed. It's just, it's quite interesting how quickly economic dynamics can change within a matter of months. Yeah.
Indeed. It's also impacted commodities markets because now there's more positive sentiment around demand because of these rate cuts. And of course, emerging markets always receive rate cut news in global advanced economies as a positive thing. Tell us about China. China has seen inflation numbers actually miss expectations.
Yes.
Yeah.
So it's quite interesting. Everybody have a different set of the problem, different types of problem. While in the US and in the developed markets, we want to see inflation trend lower because the economy is too strong. So policy action is designed to weaken the economy. What we've had in China is that the Chinese economy hasn't really recovered much post-COVID. And there's been, I think China has been suffering from what I call it overinvestment. So there's significant investment capacity and the consumer demand hasn't been strong enough, right? And post-COVID, consumer demand remains weak. And there were plans by the Chinese authority to stimulate the economy in the first half of the year, which is why the equity market recovered. And the numbers that are coming out of China suggest that some of that inflation, some of that stimulus, it's not working properly, right? And so we need to see better rebalancing of growth, because while the Western economy slows in a quest to bring down inflation, you need to see Chinese growth pick up in order to achieve the right global GDP dynamics.
Yeah,
so it's
indeed.
definitely risk worth watching.
You know, interesting, the EU has imposed tariffs on Chinese vehicle exports, so that's probably another factor driving some of the sentiment in China. But we'll now talk about Nigeria. Nigeria's FX reserves, I mean, that's music to our ears, right? $35 billion, highest since the past 12 months since the president came into power. What do you make of this reading?
So Rolake, reserves and FX has been something that I have been perplexed by.
Okay, tell me why.
And the reason is, at the beginning of the year, we had an FX liquidity crisis.
Sure.
And I was able to understand why we were having the persistent depreciation because of the market structure. Today, what we have is that liquidity in the FX market has improved, right?
Yes, yeah.
And that is reflected in the reserve growth, right? Because we've gone from below 32 billion in net reserves to over 34 billion in net reserves, net liquid reserves,
net
right?
reserves, yeah.
Gross liquid reserves, right? And despite that growth in reserves and improvement in market liquidity, if you look at FMDQ, I think yesterday was over $340 or so million of liquidity in the FX market. But somehow the spot market continues to weaken.
Yes.
And trying to
make sense between what's happening
has been.
Is it that the market is saying the liquidity has improved, but it's still not enough? Is that part of what we're seeing?
I think because we have to acknowledge that the FX market structure in Nigeria has changed, right? And we've gone from a allocative FX mechanism to a market-based FX mechanism. And in that market system, I think there are a lot of frictions. For example, I am not sure there is a proper mechanism that recycles FX reserves within the banking system. Right. So what it looks like is happening is that the CBN is buying FX and growing its reserves, but the recycling mechanism to take it back into the market, it's not as efficient as it should be. But having said that, I would rather deal with a market mechanism pricing problem than deal with an illiquidity problem. From that perspective, I actually think that we've made significant progress from where we were in January, February at the start of this year.
Yeah, I mean, you make a good point. You know, compared to 6 months ago when we were dilly-dallying at the exchange rate, the volatility was just incredible. Now we seem to have settled around some level. I don't know if we're priced at price discovery because there was some depreciation over the last week or so. But what are your thoughts on the FX market outlook?
So I'm being accused oftentimes of being an optimist. I think when I look at our balance of payments, when I look at the reforms that have happened within the FX market structure itself, and then I look at economic models so that your PPP models on where your fair value for your exchange rate is. The Naira at 1500, 1520 is extremely cheap, right? Where it settles, it's going to be a function of market sentiments and technicals. My gut feeling, and don't quote me on this, is that I think we'll probably end the year around 1.350 levels. Yeah.
That's not too far from where some of these major global investment banks are predicted. And I think for a lot of people going through this current cycle, that actually is a fairly optimistic note. So you're staying true to form, but it's a good thing. Thanks for those views. We want to move on to this story coming from the Agric Minister, Senator Abubakar Kyari, around the bid to sort of manage food supplies and deal with food prices and, you know, the duty-free importation of beans and some other commodities. How effective and lasting will these interventions be?
Okay, to be honest, this should have happened 12 months ago.
Okay.
Right? I think one of the challenges that we have as a country is I 100% support our quest to be self-sufficient in the staple foods that we consume.
Okay.
Unfortunately, the way we have gone about it has inflicted significant amount of pain to the populace. And the reason why I say that is agricultural product is a commodity. Commodities get priced at the margin. So if you have 90% productive capacity for a particular agricultural product and you import 10% of that product, the pricing of the 10% determines the price of the entire system.
Of course.
So when you have a systemic depreciating currency and then you have high duties on wheat, which is basically a staple, it goes into bread, it goes into Indomie, it goes into a lot of staples. You currently have 70% import duties on wheat, and we are currently dealing with significant level of food inflation tending towards 40%. This, when I speak to my investors and they ask me about what the most significant risk investing in Nigeria is today, I tell them it's food inflation. The price of bread in history has been known to create significant political disturbance. So for me, this is a national priority that should have been done 12 months ago.
Yeah. So essentially, the bottom line of what you're saying is that the intervention makes sense.
Absolutely.
Because of the huge pass-through effect of those key commodities on the rest of the economy.
Absolutely. Right? So the offshoot to this argument is that we need to build productive capacity. So why do we need to import anyway? Why do we need to import? Yeah. But I support self-sufficiency in food production, but we can approach that by providing direct subsidies to food producers. Okay. To ensure that food is available and food is cheap. And this is very important.
And over and beyond the direct subsidies is also the entire food value chain. There's a transportation, there's a storage. So if you provide subsidies, you also need to make sure that the conditions for transporting and getting food from farm to the table or to the market or the supermarket stalls are also pretty smooth and pain-free.
So those are long-term structural investment that we absolutely need to make, right? Because as you know, post-harvest losses is the reason why we suffer significant food inflation. And to deal with that is that you need to improve the food value chain, you need to improve the logistic network. It is insane that in 2024, a country like Nigeria uses 10-year-old, 15-year-old trucks and buses to move food around the country. Yeah. We need to improve on that.
Indeed, that's a whole nother conversation around tech and mechanization of farming. But let's talk about credit to the government in Nigeria increased.
Yes.
Whilst credit to the private sector dwarfed in comparison. Tell us, what are the dynamics going on here? Is this investment in government bonds or bills or T-bills? What is it?
I think it is. So if you look at the data, I think the net issuance of bills and bonds is about 8.7 trillion year to date.
Okay.
I have concerns around the significant pace of growth of government debt. I think we ended the year at about 97 trillion. I think we are trending around 130 trillion, which is heading towards
and you think that is 46%
of GDP. Given the level of interest rates, that is a high level of debt accumulation.
Yeah.
I mean, to put in context, if you have 97 trillion of debt stock and within 6 months you have 130 trillion of debt stock, that's an incremental 33 trillion of debt you've added to your stock in a period of relatively high interest rates. So I have significant concerns around that. But to your question around private sector and public sector, there's been a crowding out effect, of course. The interest rate environment has had to be high to deal with the excess liquidity situation that was created by the past central bank. Right? So at this level of interest rates, it is understandable that private sector credit is shrinking, right? And I think government sector should be involved in some level of fiscal consolidation, but we have yet to see
so
that.
So what can we do to reverse the tide of the shrinking in growth in private sector lending? Is it just wait for rates to come down? You know, what can we do?
I think firstly we need to address the exchange rate stability problem and the inflation problem, right? Because if you don't do that, because basically I often explain to people that exchange rate and interest rates are different form of prices and they interact with each other. What I mean by that is if you bring interest rate lower and you have exchange rate volatility, you pay the interest rate differential in the speed of the exchange rate depreciation. So you need to bring inflation down, you need to achieve exchange rate volatility, and all right, I think interest rate has to stay high until we achieve those objectives.
Exchange rate stability.
Exchange rate stability. And I think interest rate have to stay high. Once we achieve exchange rate stability and we are in a disinflationary trend, just like what we've experienced in the US,
you can start to
ease monetary policy. And when you start to ease monetary policy, my expectation is that you will see a rebound in private sector credit growth.
Okay, fantastic. Final question we want to talk about. It's a bit political, but still big deal for Nigeria because the Supreme Court has affirmed the autonomy, financial autonomy of local governments. What positive impact will this have in terms of how local governments spend on local infrastructure and services?
So for me, there is good and bad sides to this conversation.
Tell us the good.
So we need to define what autonomy is. Financial autonomy is one part of autonomy. If you have financial autonomy without political autonomy, without administrative autonomy, you've basically recreated the same thing. Because what happens is that the governors ensure that their lackeys are appointed as local government chairman, and that resources basically get spent by the government, right? So this is one positive strand in a series of reforms that I think that needs to happen. So that's one. Second part is I have reservations around the capacity of LGAs, right? And maybe that is because they've been starved of resources for a very long time.
Because of this very structure where state governments have been controlling things.
So we need to improve the capacity of the LGAs to achieve a decent level of service delivery. So that's why I said it is positive, but I think it's one step in a multi-step process that we need to engage in.
Absolutely. Great, insightful points. I wish we could continue, but we've run out of time. I've been speaking to Samson Esemuede. He's the Managing Director and Chief Investment Officer of Zrosk Investment Managers. Great stuff. Thanks for joining us, and we'll see you next time.